All right. Well, thank you everyone for attending this month's market update webinar for February 2024. Let's start with some disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only. It does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can learn more about our disclosures on our website, and throughout the presentation, if you have any questions, please submit them using the Q&A button. Quick bio about myself. My name is Jeremy Eppley. I'm a certified financial planner, accredited investment fiduciary, accredited portfolio management advisor, chartered retirement planning counselor, and I have my master's degree in personal financial planning. You can learn more about me on my LinkedIn. And Silverstone Financial is a fee-only fiduciary registered investment advisor firm. We provide comprehensive wealth management services, including financial planning, investment management, tax planning, tax prep, estate planning, those kinds of services. If you'd like to learn more about us, you can visit our website. So let's hop into it. We had a really incredible month, not necessarily in terms of performance or in terms of positive news. Just a lot of things happened in January, at least in the finance world, which was really interesting to see. The first big news that we've been waiting for a while. I've covered it over many months in past webinars, but the spot Bitcoin ETFs have finally been approved. 11 were all approved in the same day on January 10th. But there's a little more to the story. It's very interesting, a little bit of drama in the finance world, which doesn't happen that often. So first off, just a little a description of what spot Bitcoin ETFs are. So investors can go and buy Bitcoin, the cryptocurrency, on their own if they choose. But a lot of investors like to be able to invest in their retirement accounts or just have easy access to these essentially commodities. And so an ETF is an exchange traded fund, and you can go out and say with another commodity like gold, you can go out and buy a gold ETF. That exchange traded fund just holds the gold, and you as an investor gets to have exposure to that commodity without having to go and actually buy gold and have gold at your house and have to actually protect and store a valuable asset. The same thing is wanted with Bitcoin ETFs. They're a little bit easier to digest for an average investor, where you can go on to any brokerage account and buy an exchange traded fund that holds Bitcoin. Previously, the SEC kept rejecting these applications, and a lot of people, including myself, found that their rationale for rejecting them was unfounded. Ultimately, they got sued and by some stakeholders, and the SEC went to court, and the SEC lost. The court ordered them to reevaluate these applications to be able to have a spot Bitcoin ETF. They had only previously approved futures Bitcoin ETFs, which are essentially contracts that replicate how Bitcoin prices move, but it wasn't actually holding Bitcoin directly. That's what the spot means. You hold it directly. So they finally approved it. But the day before, this is where the drama comes in. The day before, on the 9th, apparently the SEC's Twitter account, or X account, got hacked, and they had announced that the spot Bitcoin ETFs were approved on the 9th. And then a few hours later, they come out and they backpedal and they said, our Twitter account was compromised by hackers, and we have not actually approved the Bitcoin ETFs. And then, the next day, it wasn't backpedaling again, but it seemed like that from a outside point of view. We watched it, And they were on the 9th, they said, no, we have not approved it yet. We have been compromised. On the 10th, they said, well, we have officially approved it on the 10th. And it's just so funny to see. Of course, it's not a good thing. You never want to see your government institutions accounts be hacked or have misinformation shared. Of course, these were bad actors. Most likely, they had money, leveraged money, or some sort of stake in Bitcoin. They wanted a big spike on a specific day, so they did this hack. It didn't make too much sense. They could have waited a day, but essentially that's what happened. And I think there are pending investigations and such. But it's just a little bit of drama. It doesn't affect anyone's day to day here. But the long story short, even though I gave you the long story, the spot Bitcoin ETFs are officially approved, and we'll be using them in our portfolios at Silverstone Financial for our clients to have a small exposure to cryptocurrencies. With all that said, again, invest your own risk, especially if you're not with a financial advisor. Cryptocurrencies are risky, especially if you don't know what you're doing, and if you're investing in some of the less renowned cryptocurrencies that can easily be scammed. So just beware. All right, our next story, a less important one, but Microsoft overtook Apple as the most valuable stock in the world. They're neck and neck, but in the past month, they are now worth slightly more than Apple. It's interesting to see. It's not that important. I'll skip over the next one real quick since we're talking about all-time highs. The S&P 500 has now hit a new all-time high on January 19th, I believe, where the previous one was in January 3rd of 2022, and we finally had a full recovery from the pandemic. And so this, of course, makes us asset managers consider, well, are we in a justifiable position to be at all-time highs, or is the market too expensive now? I, of course, as always, recommend a passive investing approach, and for clients to dollar cost average and to stay in the market and not to try to time the market. Right now, everything seems healthy and trading accordingly. So I don't see anything that is extremely panic worthy, but we're at all-time highs, which it can be good and bad news depending on points of view and what you're hoping out of the future. But it's interesting to see the pandemic behind us, at least on a stock price level. Excuse me. So back to the third notable event, it was the inflation risk. Houthi rebels have been attacking cargo ships passing through the Red Sea in retaliation for the treatment of people in Gaza. And this continued attack from these Houthi rebels in Yemen are causing not only delays, but also cargo ships being rerouted around the Horn of Africa, which adds, I don't know the exact data, you could look it up, but it's like 10 days and tons and tons of metrics of gasoline and fuel to run it. So from an environmental standpoint, it's not a good thing to see extra fuel being pushed so you can avoid these danger zones. But also there will be delays, increased cost in shipping. We're already seeing that. And all of that can lead to inflation for the end consumer, which is never good to see, especially if we're trying to overcome inflation. UK and the US are doing retaliatory strikes, trying to patrol the seas more, get it back under protection and safety for all the merchant ships. But it's an important inflation risk. It's important that I bring up the risk associated with investing. And if it's not on your normal radar, it's something that is currently happening, which is unfortunate. But hopefully it will subside and we can go on with the normal shipping routes. We'll see. Another more drama news in the finance world. This has already been appealed, so it's not technically official. We'll see how it all goes. But Elon Musk, back before when Tesla stock, he's the CEO of Tesla for those that don't know. Tesla stock had went to the moon, really shot up in price, and he was compensated with it's like $30 billion or something like that in stock compensation per his CEO compensation plan that was approved by the board. And some Tesla shareholders sued the board to try to reverse this compensation package, saying that it was unfair to average shareholders that uh, the CEO would be compensated so heavily. I think I might be wrong on this front, but I believe it was the single largest CEO compensation in the history of the world, simply because it was in stock and the stock had gone off the rails, and it was such a large number. So uh, the federal judge reversed it, and Elon Musk, if he ends up losing the appeals and such, likely will have clawbacks on that stock compensation. Right now, he's neck and neck with Jeff Bezos for number one richest man in the world, and losing 30 billion or however much in stock, whatever ends up being the actual compensation, because they wouldn't take it all away, just a portion. Um, it'll be it'll definitely hurt his ability to hold that number one spot. But again, it doesn't affect anyone's here's day-to-day lives, but it's interesting finance drama for those that follow it. Earning season is also happening right now. I won't get too much into it because I don't want to bring up too many specific stock names. We're not stock picking with clients, but just some of the big ones. Meta stock, so Facebook, is up significantly after they had a great quarter and they announced their first ever dividend. Usually that bodes well for stocks when they start a dividend or increase the dividend that they're paying. So Meta was up quite a bit, and Snap was down significantly, down 30%, I believe, today or yesterday, because their quarter was not good and their guidance for future earnings dwindled a little bit. Just two of the notable ones that a lot of people are talking about, but of course there are thousands of stocks and everyone's reporting earnings, so you can go and find some other juicy earnings season stories from normal news outlets. The final notable event here, nothing has officially happened yet, but there's a lot of talk, a lot of coverage in the finance industry, is that New York Community Bank came out with a bad quarter. They're struggling, and they're on the chopping block. Essentially, they're the closest for our new bank failure. The last one was almost a year ago, where we had 3 or 4 bank failures. Looks like there's still some iffiness in the small cap, community bank, regional bank space. And if New York Community Bank fails, others could go with it. And it shouldn't cause another financial collapse crisis like 2008, but it still adds risks to the financial system. It causes liquidity problems. It causes systematic risk, contagion risks. These are all finance terms that basically uh, it is something to watch carefully if you are in the finance space. But again, it shouldn't affect um, average people's day-to-day lives if you aren't a stock manager, asset manager, financial advisor, anything like that. I'll let you know if we have any other news next month. But for now, we're okay. Nothing has officially happened yet. But talking about 2008, I wanted to spend a few minutes talking about what has been happening in China. Now, this is not a new story. It's just not something that we've been talking very much about. I think a few months ago, I might have mentioned Evergrande Group as a line item on one of the notable events for that month. But uh, I'll just recap a little bit about what's happening in China. So right now, China is having, in a simplified form, their 2008 financial crisis right now. So what we had in 2008, China is facing. It's real estate associated, and it's causing a whole lot of liquidity problems. It's having bank failures. It's having real estate company closures, bankruptcies. It's hurting their economy. It's crushing their stock market. Lots of bad things are happening in China right now. The first time that we saw this was when Evergrande Group, so I believe it's their largest real estate developer, if not the largest, a very large one. They were worried about they might default on some debt. And this was months and months ago. A few months later, they officially defaulted on the debt, and then they went into bankruptcy. And now, it's, I think maybe a year later, 8 months, 12 months, something like that. There have been other problems across the real estate sector, across other parts of their economy, finance sector, all the mortgages, how it's structured. It's been very problematic. Their stock market, this is the year chart, is down 12.5%, while the rest of the world in 2023 was up. So they're one of the laggards in the markets. But this has been happening for almost 2 years. Their economy has really, really struggled since COVID. They shut down harder than anywhere else in the world. And on top of that, with the real estate problems of how they were lending and how they were building, essentially is oversupply. They just kept building and building and building with subsidies from the government. It has all come crumbling down. How does this affect you? Oftentimes, when you see these large financial crises, in 2008, what happened is, it was an American crisis and America was hit hard, but other places across the world were demolished. Their economies were crushed just as hard or harder. Like if you look at Iceland, they were highly dependent on the US economy and they had worse outcomes than the US. And in 2008, even though they had done nothing wrong, you see this is what you call a contagion effect. The one bad sector causes a problem in the economy, which causes a problem in the global economy. So when you see such a large country like China, who's so vitally important to the global economy, having these problems where it's not just their stock market, it's not just their real estate, it's not just their finances, but they're having problems with manufacturing and logistics and all this kind of stuff. China just passed some stimulus packages to try to fix some of these problems. This is a worry, another risk that it could be contagion effect into other neighboring countries, into even the U.S., into Japan, into Korea, into Europe. China is connected with everything because they're such a large part of the global economy, manufacturing and such. With all that said, I don't think it's that large of a risk. What's been really interesting is the U.S. economy has been the number one economy since COVID, out of just about anywhere in the world, because of number of policy decisions and also just how our currency works and how our position in the world, financial systems work. We had a stacked hand, and that really helped us when everyone was suffering from inflation and COVID and supply chain problems. Now China had the opposite effect, and while China suffered, the U.S. economy has continued and kind of ignored the China problem, and the China economy contagion hasn't happened. I would say that I'm not an economist. I'm not a geopolitics expert, but I don't see this as that large a risk if you're not heavily invested in China. The downside is a lot of people are heavily invested in China. Those that don't know, in a 401k, if you're in a target date fund, usually it has heavy exposure into international markets. International markets are heavily dominated by the Chinese markets. If you invest independently for the past 10, 20 years, because of the China's stock market has done so well, and a lot of advisors have recommended China as a part of a portfolio. Now, the past year and a half has been the opposite. A lot of advisors have been warning against investing in China. They've been calling it uninvestable. Now, for those of you listening that aren't clients, you might want to check where your money is at, how it's invested, and see if this is a concern for you. I can't give you any specific advice without knowing your situation, but it's something to look at. Is how are you invested? What's your exposure to China? For those of you that are Silverstone Financial clients, know that since I launched the firm, before this happened, I avoided China because I didn't particularly like how their economy was set up. You know, the politics behind it, the over investment. It was too much euphoria. Everyone was like, "Well, the past 20 years have been great. It has to continue," and I don't usually like that mindset. So for a long time, I've been recommending India as the ideal international market to invest in for a number of reasons that I've explained in the past. And when you look at them in the past many years, India has been doing great, not as well as the US economy, but almost as well as the US economy, one of the best international markets to be investing in. So for those of you that are Silverstone Financial clients, know that already this shouldn't be that big of a concern for you. But I'm glad I brought you all up to speed. It's something that's happening that's not very heavily covered in the U.S. And it is very important in the world of finance, since China is so important in the world economy. So those are the notable events. Now let's just fly through what's happened in our U.S. markets in the past month, and maybe wrap up with some questions if any come in. So for those of you that haven't seen this before, this is a heat map. This is how I look at the markets each day. The larger the square, the larger the company. It's broken up into the 11 sectors of the economy, like technology and consumer defensive, energy, real estate, healthcare, financials, that sort of thing. The greener the box, the better the returns. The redder the box, the worse the returns. And you see some of the, the bright red one, or the bright green ones rather, are like Meta, the one I had mentioned, Merck, Eli Lilly. These are healthcare companies. Nvidia had quite a good month. I had mentioned before in a previous monthly market update webinar about my caution around Nvidia, simply because of how expensive it's gotten and how much it's run up. It's been great for those that have been holding it, and I don't necessarily recommend to buy it or to sell it, but it has just been incredible to see it. I think it was up 200 or something % last year. It's incredible to see it, and it's continued going up at least slightly for January. Some of the losers, we see Tesla. It kind of got over its skis as well. As the worry I have with Nvidia and some other stocks. Down 25% for the month. That's pretty bad. Boeing, I don't know the actual percentage, but Boeing, have had a lot of bad press with the door popping off and the loose bolts, if you've heard of it. They've been down, and some other parts of the economy have some red around it. Looking over some indices, the Dow Jones was up about 1.2%, S&P 500 1.6%, mega cap names, so these large caps, tech names, up 3%. Small caps, very different from the mega caps, down 4%. A lot of that has to do with the regional bank problem. Now that it's resurfaced, people have been avoiding these regional banks. Also, biotech had some of these are some other small cap stocks. Those have had a problematic month. Global economy down 1.2. Aggregate bonds didn't do much. Gold didn't do much. Oil slightly up 6%. And Bitcoin, which was interesting, it was almost flat for the month, even though this was the most consequential month in its history where it had spot Bitcoin ETFs approved. And it was like $10 billion pushed into Bitcoin to fund these exchange traded funds. It was interesting to see it not move very much. I have to just really point out this trend of mega caps have outperformed in the past and small caps have underperformed, and it's been continuing, which is interesting to see. but across the board, it's kind of a boring month. These numbers aren't particularly high or low, and some parts of the economy are suffering, or the stock market are suffering. Others are doing well. It's kind of what you see when you see a earnings season. It shows what is doing well, what is doing badly, and there's a flow back and forth to try to equalize the valuations for everything. So a normal month, nothing too serious to worry about. This is going to show a very similar, since year to date, it's only been a month, it's the same chart, but everything's a little bit duller, less bright, because the range is larger since it's a year to date map. So just to remember that everything's into context. There are some big swings for the month, but in the long term, it's not that impactful. I always like to show this chart, which is the average monthly S&P 500 index returns month to month. It helps show the cyclicality, the seasonality of the stock market, which is normal. Now we had a very traditional January where the average January is up 1%, and we had a 1.6%, which is totally in line. February, on average, usually is a flat month, which usually means it's one of the worst months. It performs slightly worse, sometimes it's down. So I wouldn't be surprised if next month is down simply because January is up. But based off of the chart I'll be showing you a little bit later, I think it's kind of hard to tell. It's kind of going to be a coin flip, but I'll talk a little bit more about it in the next slides. But just know, the first 4 months are usually pretty good. 1%, flat, 1.2, 1.5. It's usually a nice start to the year after a good run up, which we did have. We had the Santa Claus rally. Not much to say. In previous webinars, we talked quite a bit about the Federal Reserve and their rate hikes and such. Now we're kind of in just waiting for rate cuts. I don't think they're happening anytime soon. I would be surprised if we see anything for quite a few months. I would say mid-year is likely when we're going to see the first rate cuts, and they're going to be small and slow, and we'll probably have 25 basis points every other meeting. That's my guess. So there are some economists and analysts that are expecting lots of rate cuts, but you'd only see that if the market or the economy really tanks, and we don't hope for that, and I don't necessarily see that happening. So right now we've been having a Goldilocks scenario with the economy, and it's doing quite well. And hopefully we'll see that continue, and the Federal Reserve will act accordingly. I'll keep you all up to date when we know more. All right, this is the last chart for the night. So usually I talk about the chart, and there are some lines. I decided for the new year I was going to clear off those lines, and I'll draw some new ones maybe next month as I see some more stuff happening. But these past arrows were what I predicted each month. I like to show that so that people realize that I'm not perfect and no one should be. And anyone that says they'll always know what happens in the market is lying or incorrect. So the yellow ones are the ones where I got wrong, and the ones that are green or red, I got right. So the first time I started, recording this month to month, June, I was wrong. Yeah, I said it'd probably go down. It went up, which was nice. And then in July, thought it would go up, and it did. August, thought it would go down, and it did. September, same story. October, I thought it would go up here, and it didn't. I was a month late, early rather. And then I thought it would go up. And for January, last month, I thought that we'd probably give up some of the gains, but we actually had another good January. Slight. It kind of traded somewhat flat. It depends on what parts of the market you were looking at, but we went up. And for this next month, again, I'm going to say it's kind of a coin toss. It's really hard for me to say based off of where we're at. I would edge toward it going up a little bit more, still having a similar month to this month. I don't think we're gonna have a huge crash unless we have some new event that is unforeseen come out. But yeah, I would expect it'd be a coin flip, probably like 55% chance it'll go up slightly and 45% chance that it'll go down. So I always like to mention or remind people that these are just my opinions and the best thing to do. Plenty of scientific studies, research papers have proven that dollar cost averaging over time, passive investing, not trying to stock pick, not trying to time the markets, is the best way to build wealth long term. So I bring these opinions, this webinar to try to educate, to prevent people from panicking in the markets, but it's not trying to convince you or trying to encourage you to stock pick or time the markets. Stick with it and stay invested and try not to think about it too much or worry about the markets too much. So we'll finish up a Q&A. I saw two come in, but they were both about the China Evergrande situation at the beginning that I covered during the talk, that what I had said. So those are covered. I won't repeat myself. I haven't seen any other questions come in, so I'll wait for a minute or two. But if nothing else comes in, I'll be wishing everyone a happy night. Good luck for a good February. I'll see everyone in March, hopefully with more good news. Maybe some more interesting months. I always like to have months where I have a lot to talk about. And yeah, everyone have a great night. I don't see any other questions come in, so have a great night. Talk to you next month. Yeah.